Warren William here from Smartest Data, hoping to make investing in and analysing stocks a little bit more straightforward. Okay, so last week or so, CNBC ran a segment on the top 10 stock picks by Wall Street analysts going into 2023. The list was compiled by a survey and really focused on large cap stocks. So some of the stocks I can see a path forward. Other stocks for me, I think there's very little chance. Okay, so let's go to the video. I'll do a quick review of what stock picks actually are, what it means. Then I'll take a look at the analytical community with 3 weak points to keep in mind, run over the CNBC video. Then towards the end of the video, I'll review these top 10 picks and I'll give my take on what's needed for each stock to either justify being in the top 10 stock pick list or if they're not justified. And I'll use bar chart as my database. Okay, so let's take a quick minute to focus on the analytical community. They're often quoted, interviewed, voted for who's best, so it's a very high profile position. Remember, equity equals ownership. They speak to senior management. At the broking firms, there are teams of analysts following individual stocks, mainly divided along sector lines. I was a research analyst for over 10 years, mainly bank stocks and also industrials. Okay, first off, what are stock picks? What does it mean? So stock picks are basically recommendations made by analysts about specific stocks that they believe have a strong potential for price appreciation or at least outperforming either their sector or the main index such as the S&P 500. The valuations are typically based on ratio analysis, then comparing the various multiples, P/E ratio, dividend yields against similar companies, taking into consideration other aspects such as P&L growth and other factors which are out there. Okay, the analyst recommendations can be based on a variety of factors such as a company's financial performance, stock market trends, economic outlook, and also the competitive forces within their respective industries. Analysts make their stock picks based on their own research. This will often involve the analysis of a company's financial statements, so the profit and loss, balance sheet and cash flow statements, then projecting these statements out for the next 2 or 3 years. They will look at trends in the stock market and industry factors, and the analyst will look to the company to provide further information. The analyst will consider also external factors such as macroeconomic conditions, government policies, and global events that could impact the stock market. From my experience as an equity analyst, I believe it's important to keep the following 3 weaknesses which the analytical community can suffer from. So keep in mind these following 3 issues. The first one, they tend to move in packs. In other words, no one really wants to put their neck out and be wrong. They are competitive. They will be ridiculed if they are wrong. Yes, there are some analysts who are leaders on specific stocks, but still they all tend to move together. Second, follow me on this one. They tend to change their estimates in increments. So if an EPS figure needs to be adjusted from, say, $5 per share to $5.60, so a 12% hike, 60 cents, thus instead of doing the 60 cents increase in one go, an analyst is more likely to do 3 revisions. So from $5 to $5.25, then a week or two later, $5.25 to $5.45, and then from $5.45 to $5.60. Yes, they're following their stocks. Also, they don't want to make the previous figure, the $5 figure, seem ridiculous. They get struck by this banter. So what is it? You didn't understand the stock before or are you getting it wrong now? This is the sort of dialogue chat which they have to deal with. Third, the analysts are always a little bit late. Look, it takes an effort to write, to speak to the company, then to communicate with a team of brokers, then external clients such as institutional investors. I'm not trying to say they're lazy, but this is just the way it is. In conclusion, the analytical community is an extremely dedicated, hard-working group of professionals. One thing they do really well is their estimates. They focus on them, and this, as I believe, is where they're value added. The things they do really badly is to make recommendations. In fact, I don't even think they should be making recommendations. Look, in 2022, over 60% of the recommendations were buy recommendations. So in my view, focus on their estimates, use that information, ignore the recommendations. Do it yourself.
Fully named. We picked out the 10 biggest stocks by market cap, which have so far popped up on an analyst or analysts' top picks list. There they are. If you're on your car driving, I'm going to name them. Alphabet, Amazon, Tesla, Nvidia, some company called Comcast. You go, Comcast. Raytheon, Netflix, Qualcomm, and Boeing.
Okay, looking at the CNBC portfolio, the sector representation, 5 stocks come from the tech sector, 3 from industrial, 1 oil, 1 media. The betas range from 1 through to 1.9. Stocks that were positive in 2022 were Exxon up 73% and Raytheon up 12%, compared with an S&P 500 which was down 20%. The portfolio is definitely a portfolio that looks beyond a recession. It's quite feasible that a portfolio such as this could work this year. Anyway, let's go to the individual stocks and let's have a look at the graphs, the statistics, and the overall impression. Okay, before we move on to the 10 individual stocks, the purpose of these videos, Stock Market Analytical Ratios, is to give you confidence to act as an independent investor. I use the database bar chart. I'm a part of their affiliate program, so there's a link below if you wish to subscribe. Absolutely fantastic. Otherwise, if you like these videos, hit the like, subscribe button. It really does help the channel. Also, there's the quick definition videos which are out there. There's around about 170 of them, and they're there for an educational service to you. Alphabet Google is a multinational technology company that specializes in internet-related services and products. These include online advertising technologies, search, cloud computing, software, and hardware. In the online search area, Google is a monopoly with more than 94% of online search volume. The company also offers a range of products and services including advertising technologies, cloud computing, software, and hardware. First off, Alphabet, $1.1 trillion in market cap, $257 billion in sales, a beta of 1.06. Okay, so looking forward, the forward price earnings is 18.9 times, and if you look at the ROE, it's around 26.5%. Revenue growth and earnings growth has been very strong over the last 5 years, but over this next quarter, we're looking to have a decrease in earnings. This is an issue for Google. Okay, so the performance in last year was down around about 38% or so. Okay, so what to consider when investing in Google? It's an absolute bellwether stock. The stock is not particularly stretched as far as valuations go. I think this is a stock you should start to investigate and take a look at for the longer term. Amazon is a multinational technology company that specializes in e-commerce, cloud computing, and artificial intelligence. It is one of the world's largest online retailers and provides a range of products and services to customers around the world. The company has a diverse range of products and services, including online retail, e-commerce platforms, cloud computing, and artificial intelligence. Okay, starting off with Amazon, sales of 470 odd billion and bottom line of around 33 billion, a beta of 1.19. Okay, so price earnings at the moment is 122 times. There is an earnings slump going on at Amazon. The return on equity is about 14% or so. So revenue growth and bottom line growth, earnings growth has been strong over the last couple of years, but as we can see, EPS growth versus previous year is expected to be down around 34%. The stock has reflected this. The stock has been down around about 50% in 2022. At this point in time, regarding the various graphs, the studies, so Bollinger Bands, nothing untoward here. Stock's trading about midline. Investment thesis for Amazon, absolute bellwether stock going through an earnings slump. Let's see what the earnings guidance gives, beginning in February. Positive, this stock can rebound. Tesla's stated mission is to accelerate the world's transition to sustainable energy through the development and production of electric vehicles, electric storage systems, and solar panel systems. Tesla is rated as a technology company that designs and manufactures electronic vehicles, energy storage systems, and solar panel systems. The company's range of cars include luxury electric sedans, SUVs, and pickup trucks, as well as electric semi-trucks and electric sports cars. Okay, so next stock is Tesla. It's in the news a lot at the moment because of the Elon Musk story, and I think that's impacting on the shares. So it's on a beta of 1.9. Okay, so the price earnings ratio going forward is 33 times. Return on equity is sitting at 31%. I'm not going to harp too much on the numbers with Tesla because I think really the outside story of the involvement with Elon Musk, Twitter, and the Tesla shares is something which is impacting the stock. It's had a horrible year this year, as you can see down around about 69%. So Is Tesla to be rated going forward as a high-growth tech company, or is it a car company? At the moment, the multiples are pushing it more towards the tech area, but I think it's going to start to become difficult to justify these multiples unless the outside story impacting the stock starts to clear itself up. ExxonMobil is a multinational oil and gas corporation and is one of the largest oil and gas companies in the world with operations in more than 50 countries. ExxonMobil is involved in every aspect of the oil and gas industry, including exploration, production, transport, and marketing. The company's primary products are oil and natural gas, but it also has significant presence in the petrochemical industry, producing a range of chemicals and plastics. Onto Exxon. It had a fantastic year last year, the rise in the oil price. It's on a beta of 1.13 times. Okay, so if we look at the forward earnings multiples, price to earnings is 7.9 times. Return on equity is around about 29.5%. The story really behind ExxonMobil in 2022 was the oil price. I think to be positive on this stock and to buy it going forward, you've got to think that the oil price has got to rally again. I don't really see it, but because of that, the stock massively outperformed the index, up 73%. As far as we look at the various studies, nothing untoward. It's at the high end of the range of volatility within the Bollinger Bands. There's been a crossover, and MACD is indicating a buy, and the RSI is trending up. Nvidia is a technology company that designs and manufactures high-performance graphics process units, GPUs, and other specialized computing hardware. In addition to GPU business, Nvidia also provides a range of software and hardware solutions for artificial intelligence, self-driving cars, and other emerging technologies. Nvidia is a leader in the graphics and computing industry and is known for innovative products and technology. Onto Nvidia. It's clearly a growth company. It trades on a beta of 1.75, so if you're positive on the market, you would take a look at this stock. It's in the area where experiencing a massive growth. The price earnings multiple is a massive 65 times. Return on equity is 30.7%. Its growth over the past couple of years due to the growth in video has been massive as well. Okay, so going forward, the EPS growth year on year is expected to be negative. This is an issue for Nvidia, and this has caused the price decrease of around about 50%. Okay, so moving forward, what can we see? If we look at the studies, the Bollinger Bands, it's sitting at the lower end of the Bollinger Bands at this point in time. Regarding the MACD is currently negative. We had a crossover a couple of weeks ago, and the RSI is sitting around the oversold area. It's an interesting company, Nvidia. Take a look. Comcast is a telecommunications company that provides a range of services including cable television, internet, and telephone services. It is the largest cable television provider in the United States and one of the largest providers of internet and telephone services. Comcast also owns and operates a number of media and entertainment companies. Okay, moving on to Comcast, operating in the telecoms and media industry, which was the worst performing sector in the S&P 500 last year. Okay, if we look at the price to earnings ratio going forward is 9.7 times and return on equity is 17.6%. The company has not really been a growth company over the last couple of years, and there is expected to be an EPS decrease compared to last quarter. So moving on to the graphs, you can see the stock fell by about 31% last year. And if we look at the Bollinger Bands, nothing untoward there, straight in the middle of the range. And also same with the MACD and also the RSI. I think to be positive on this stock, you've really got to look beyond a recession and hopefully an increase in ad revenue. Raytheon is a major player in the defense and aerospace industry, provides a range of products and services to customers in the United States and around the world. The company's products include radar systems, missiles, and other defense-related technology. Raytheon also provides a range of technologies and services for other government customers, including cybersecurity, intelligence, and training. Raytheon is known for its innovative technology and expertise in the defense markets. Next on to Raytheon, operating in the defense area, partially. Okay, so it's on a beta of 1.07, so in line with the market. Raytheon sitting on a forward PE of 21 times and an ROE of 9.4%. Look, it's difficult on the valuation ratios to be positive on the stock. I think it's the underlying story in defence and the probable increase in defence spending which is going on around the world. There is an expected decrease in EPS from this quarter to the last quarter. Anyway, moving on, so you can see the stock did do well last year, up 12%. Regarding the Bollinger Bands, you can sort of see here that sitting up at the top range, nothing untoward there. Investment thesis for Raytheon depends really on the underlying story, that is increase in defence spending due to the war in Ukraine and other hotspots around the world. Netflix is a media company that offers a subscription-based streaming services for movies, television series, and including those produced in-house. The streaming services allows customers to watch a wide range of movies and television shows, including original content on the internet-connected devices. The company has a large range of licensed content, as well as a growing number of original series of movies. Okay, on to Netflix operating in the streaming area. Sales of around about $29 billion and a beta of 1.29. Okay, if we look at the earnings models going forward, price earnings is around about 28 times and return on equity is 27.6%. Streaming is a very tough business, and Netflix has been in the news about losing customers or gaining customers. There is actually the expectation that EPS growth could decrease going forward for the next quarter. Okay, so you can see Netflix was down 50% this year, so massively underperformed the market, not dissimilar to a lot of technology stocks. Look, nothing untowards in the Bollinger Bands, and I think really going forward to be positive on a stock like Netflix, you've really got to be looking at their streaming numbers going up, and I'm a little bit doubtful about that at this point in time. Qualcomm is a technology company that designs and manufactures semiconductors and telecommunication equipment. Qualcomm is a leader in the wireless technology industry and is known for its expertise in mobile communications and data transmission. The company's products include chipsets, modems, and other technology that is used in a range of devices, including smartphones, tablets, and other mobile devices. Okay, so on to Qualcomm, a $123 billion market cap company with annual sales of $44 billion and on a beta of 1.2. Okay, if you look at the valuation ratios, forward price earnings ratio of 12.3 times and a massive return on equity of 86.7%. Okay, Qualcomm has had solid growth over the last 5 years and is looking to increase growth over the next quarter. It was a tough year for all technology stocks. Qualcomm wasn't excluded, down 41%. This is a company which is in a good position, and looking at the Bollinger Bands at this point in time, it's at the low point. Okay, the investment thesis for Qualcomm is probably a general rebound in the tech sector and wireless spending, telecommunications spend. Let's look towards earning guidance at the beginning of February 2023. Boeing is an aerospace company that designs and manufactures aircraft as well as provides a range of defense and space-related products and services. The company's products include commercial aeroplanes, military aircraft, satellites, and missile defense systems. Boeing is a major player in the global aerospace industry and has a significant presence in the defense sector as well. Okay, on to Boeing, the final company, and for the life of me, I do not understand why Boeing is in the top 10 of possible analyst stock picks for 2023. The company is currently in losses at this point in time. There's been all sorts of problems at Boeing over the recent history, and it should be benefiting from the spend in the defense area, but I think there's such internal problems. I don't think this stock is something which is a buy at this point in time at all. The stock lost about 10% last year, so on a down market, that's not too bad, but considering where Raytheon was, the stock did underperform. There are some indications with the Bollinger Bands. The MACD is slightly coming through. The RSI is in the mid-range.